It seems like I've seen some people coming into my office, and the feedback generally is pretty good, and it seems like it's at least enough to kind of spark the conversation.
Peter,
yes,
I gotta cut you off. So there's no audio, so we're gonna redo that intro.
Awesome.
So stand by, everyone. So I just saw your message, Scott. Thank you. So you've not missed much, but we're just gonna restart it for the recording. All right, take 2 on the business entities. We're good this time.
If you say so.
Hey, everyone. Chris Lopez here. For those who don't know me, I'm a real estate agent at Your Castle Real Estate, and I'm an investor myself, and I help a lot of other people go out there and buy rental properties and put together their rental property portfolio for long-term retirement planning. And so a question that always comes up as we are buying properties or acquiring properties is, hey, what type of entity should I put my property in? What do I need to do for tax reasons and legal liability reasons? And, obviously I'm not a lawyer, but I say those are great questions, but luckily I do know some very smart people where that is their expertise. And so I always connect them with the appropriate person, help them get those questions answered. And we are actually doing this webinar as part of our 3-part series on business entities for real estate investors to give people a basic curriculum of information. So great, you got some questions, go watch these episodes or listen to these episodes, give you that very foundational material so hey, here's some options, here's some very high level stuff, and go out there and either talk to our guest today or another lawyer and start putting together the right legal structure for you. So my guest today is Peter McFarland, who is a lawyer with the Business Innovation Group. Peter, glad to have you back.
Yeah, thank you, Chris. Glad to be back. And yeah, at this stage, it is our 3rd part of this series, and actually the 6th webinar that we've done overall this year, which has been a blast. I really enjoy doing these with you, Chris, but at the same time, kind of glad that we're also at the end of the series as well. I can move on to other things. But to everybody who's on this call, who's listening and, kind of soaking up some of the information that I'm sharing, it's interesting. I've actually, now that we've done so many of these, have begun to see people coming into my office who have seen these. And it's really cool because actually the early kind of conversations or the baseline of the conversation has almost already happened, right? And so when we actually do have that initial consultation or, we're ready to kind of talk about their particular situation, that conversation actually can be more meaningful and more helpful because the groundwork has already been laid. So, I commend everybody who's here because I think you're thinking about the right things or kind of going down the right avenues. And then hopefully the information that I'm sharing with you is actually helpful for you to kind of further that conversation. And by this stage, I hope nobody's at least tired of my voice or something like that. So.
No, this is, we always get great feedback on your presentation. So looking forward to digging in.
Thank you. Yeah. Well, at any rate, once again, here I am. I can't help but give myself a little bit of love. If I don't do it, who will, right? At any rate, if I just talk about myself and my accomplishments or kind of who I am, that really leaves out a huge part of the picture. And really, I have to throw it out to my team as well. So here's a picture of my team. There are a few others, but that's kind of the core of my team. And everybody that you see on this slide is actually a professional. Nobody can know everything, right? Nobody is just that savant that can answer every single question about every single area. So I rely quite a bit on my team. But we at Business Innovation Group, we focus on business advisory and planning, revenue and profit improvement, cash flow analysis and forecasting, tax planning and preparation, bookkeeping, business entities, development of executives, and real estate strategy and planning. And it itself, Business Innovation Group, is a sister company to our law firm that provides more traditional kind of legal services as well, such as compliance work, defense and audits, and estate planning and real estate law. So we really cover quite a bit of ground and really try to be as much of a one-stop shop for real estate investors as we possibly can. But that's enough of a plug. I actually have a lot that I'm going to talk about today, and I'm really excited to talk about this stuff today because I was telling Chris before the beginning of this webinar, I actually don't talk an awful lot about corporations themselves because it seems like we often go more the direction of LLCs, taxes, partnerships, or other strategies that we've talked about in, say, the 201 presentation that we've done, which I do recommend you go back and look at. But at any rate, today's really exciting because I often don't get to talk about these particular concepts or strategies or what we're going to talk about today. So just as an opening perspective, I want to back up and look a little bit at kind of what we are going to talk about today, but then kind of compare that a little bit to what we're not going to talk about today in great depth, mainly because if you're interested in kind of some of these other things, go back and watch 201 or go back and watch 101 because that'll be helpful to you. Today, what I'm really going to be talking about is active income. In the tax code, income is actually split up into different categories. A real easy kind of distinction, it's not technically correct using the right kind of vocabulary, but it's easy to think about, is active income versus passive income. Rental income, for instance, anything coming off of buy and holds is going to be that passive income. And so the strategies that I'm going to talk about today it's just really not geared towards that rental income. Really, today we're going to be talking more active income. So if you're a real estate broker, your ears should be perking up. If you're a fix and flipper, wholesaling, buying tax liens, anything where you're kind of actually self-employed and earning more active income, that's going to be where the talk today is going to be the most helpful. This is just kind of a visual representation of, okay, look, there are these different types of income. And if you're kind of falling more on the right-hand side of this, where we're talking about passive income and passive losses, really, that's not going to be very helpful for you today. We're going to focus on this normal income. And so ultimately what that looks like is that we may have separate structures entirely, right? And so for those of you who are listening and maybe can't see the slides, on the left here, I have the structure that I've been talking about since pretty much day one, even in the tax planning webinars that we were doing. Basically we have a master LLC and sub LLCs underneath that. That's really going to be a rental income kind of strategy. But you may set that up in addition to an S corporation or a C corporation, if it makes sense, kind of based on the strategies that I'm talking today. So the temptation, or something that I see quite often, is that somebody will go out and they will set this up on their own with no help, no advising whatsoever. And they want to create like an S corporation or a C corporation as a parent company over everything, right? They want to combine the active income and the passive income with kind of this parent company, distill everything back to one company, one bank account, one tax return. And the answer there is that you just really can't do that because the tax strategy is so different. You're going to give up quite a bit of benefit, may even get yourself in some trouble down the line if you do combine everything and distill it all down. So we're really going to be talking about maybe separate structures, big picture, if you're going to be going this route of corporations for active income. So that's more or less my opening perspective there, right? So this is a question that I get all the time, and it normally happens at trade shows, which this weekend there's going to be a really great trade show. Yeah. Chris, do you want to talk a little bit about that, or?
We're talking about the event this weekend?
Yeah.
Well, we're doing the Investor Success Summit this weekend, which is the annual summit, real estate investing summit here in Denver. So I'll be speaking there. Peter's company will be there. So it's a great venue to come learn and network with other people around Denver. But I'm really curious. So is LLC or corporation, what's better? We can end the webinar.
Right. Well, see, I'm kind of stacking the deck. Because there really isn't a real great answer to this, and in some ways the question actually is kind of meaningless, and I'll show you why. But pretty much any trade show I ever go to, I get asked this question: LLC or corporation? Which one do you set up? Right?
Well, I think it really depends, right?
Well, it always depends. Yeah, it always does, and it depends on what you're looking at. But from a real 10,000-foot perspective, just backing up and looking at it from a really high level, they look really similar, right? And so basically with a corporation, the way that you're going to set them up is you're going to file articles of incorporation. Then you're going to draft bylaws, and bylaws are just going to be rules about how you're going to run the company. Then the people who are in charge, they're the board of directors and the officers, right? And you get limited liability out of a corporation. So if you can distill down kind of like 4 main points about a corporation, you've got articles of incorporation, bylaws, board of directors and officers, shareholders, and liability protection. Well, the flip side of that would be, let's look at an LLC, right? An LLC actually looks really similar. An LLC has articles of organization instead of articles of incorporation, right? An LLC has an operating agreement instead of bylaws. Instead of a board of directors and officers, like in a corporation, an LLC instead has members, right? Maybe you have a manager, but it's not necessary. You just mainly have members. And then both of them are going to have liability protection. So from afar, really, they're very similar, right? In just kind of their basic brass tacks. But that said, the devil's always in the details. And so what I've done here on this slide is kind of show you kind of a visual representation of how this actually kind of plays out were you to set up a corporation versus an LLC. LLC, very simple. You have a manager or you have members. They have limited liability, and the manager and the members, they have the management. It's as simple as that. It really is a very simple structure. With the corporation, on the other hand, though, you have the board of directors, and the board of directors will elect officers. Now, the board of directors kind of have control over the day-to-day management of the company, and they exercise that control because they can always fire the officers, right? The officers manage the day-to-day management of the corporation. So we're talking the president, the vice president, the treasurer, right, or the CEO, the CFO, however you want to kind of style it. But either way, the officers are answerable to the board of directors, and then the board of directors are ultimately answerable to the shareholders. So the shareholders have ultimate control over the corporation, but they have no management, really no day-to-day. The best they can do is just fire the board of directors if the board of directors isn't getting the job done through their choice of the officers, right? And then if you follow liability is kind of interesting because the board of directors actually have liability. They have liability to the shareholders. They owe them fiduciary duties, right? To make sure that the corporation is actually doing what it's supposed to do and looking out for their best interests and their financial interests. Officers have liability to the board of directors, but the shareholders have limited liability. So it's just the devil's in the details because, like I said, kind of on the last slide, at the brass tacks, they look very similar. You have articles of incorporation versus articles of organization. But then when you kind of get down to actually running the corporation, it's very different because you have this kind of separation of powers in the corporation between shareholders, officers, and the board of directors.
Now, from, like my perspective, and I think most of our listeners' perspectives, like, great, they're looking at the corporation route. I have no plans on taking a company public and having hundreds of employees.
Right.
It's going to be, in my experience, I'm going to be the one-man show. So if I'm all of this stuff, does that really make a difference other than on paper?
Yeah. I'm smiling because this gets to a point that I'm going to make later, and we'll return back to it. It's no problem. But basically, I have trouble getting my clients to just have one annual meeting with an LLC. Right. But if you are the board of directors, the officers, and the shareholders, every single year, you actually have to have 3 separate meetings to keep up your corporate formalities. You have to have a meeting of the shareholders, a meeting of the board of directors, and a meeting of the officers. Right. So imagine.
That's news to me. Yeah. I've had like 3 S corporations over the years. Okay.
Well, no, I mean, it all comes back to how formally are you running your company, right? And all of those corporate formalities. And that's really important. And so if you look at the Colorado statutes, right, the LLC, for instance, it specifically says in the Colorado statutes that an LLC doesn't even have to have an annual meeting, right? That's not fatal to its asset protection. Now, that said, that's not best practice, right? You still want to at least have that annual meeting because if you go in and you do get sued and you can show the judge that, you have an operating agreement, the operating agreement says you're going to meet annually, you have 10 years of meeting minutes, that looks really good. It looks really formal. You're going to get protection out of running it that way. Versus, the statutes with corporations are very different. They're much more rigid. A lot more formality goes into running corporations. And yeah, if you're lax on these formalities, that's going to give somebody an avenue to push through and pierce your corporate veil. And we're going to talk about that a little bit today too. Some of it'll be review from 201, but it's good to kind of hammer that in. But at any rate, yeah, if I struggle to get my clients to have one meeting for a limited liability company, imagine that conversation when I say, and really you should be having 3 meetings with the corporation, right? So that's a really good question though, Chris. Thanks. Okay, so We're going to talk about two different types of corporations today, and we'll talk about the advantages and disadvantages of both. Basically, there's C corporations and S corporations. Some people think that S corporation stands for like small corporation or something like that. That's not true. It basically is just what subchapter out of the tax code it comes out of. Subchapter S is for S corporations. Subchapter C is for C corporations, right? But at any rate, let's talk about C corporations in particular. Basically, with this, you're going to get some advantages out of it. There's going to be personal liability protection. So if you are sued, corporations are very strong for asset protection purposes. The idea of that corporate veil has been going back for hundreds of years, and that as a legal concept predates the United States. It actually goes even back into common law in England. So there's hundreds of years kind of showing that these corporate entities are separate and distinct legal entities from their owners, and they give personal liability protection. So corporations really are great for liability protection. Some would argue even better than LLCs, because LLCs maybe only have 20 or 30 years of case law saying that they're going to be protected, right? There's limited risk of loss, mainly because of that liability protection. And then there's great tax planning potential revolving around C corporations. There's preferential corporate rates. And so if you are one of the taxpayers who are fortunate enough to fall into a high tax rate, the ability to transfer transfer income down to a C corporation and basically benefit from a flat rate of 20% versus a potential marginal rate of 30 or 40% on your personal side may make sense. And so there actually is some tax planning potential just in shifting income. But I'm going to talk more about specific, less shifting strategies and more things that we can implement that a C corporation might be able to offer that otherwise we might not be able to take advantage of. So mainly a C corporation would be useful as a management company, and then maybe for dealers and flippers, but we'll also look at S corporations for dealers and flippers. The disadvantages of a C corporation, everybody, well, maybe not everybody, but most people, when they talk about C corporations, know about a double taxation problem. And I'll show a little bit about what that is. But certainly C corporations have this double taxation problem. Tax losses stay with a corporation, and so they're not recommended for rental properties, right? Basically, I have a lot of clients who got really bad advice in the past and put rental properties in a C corporation, and those rental properties have kind of spun off losses. They since have sold the properties, and now they're just stuck with this shell of a C corporation with losses, and they're just waiting for those losses to get used up. They can't accelerate that or try to use it on their personal return in any kind of more beneficial way.
Because it's not passing through from the corporate to the personal level like it does on LLC or S corp.
Exactly.
Okay.
Yep. So it stays with the corporation. Now, when you pay yourself out of a C corporation, you pay yourself one of two ways. There's you can pay yourself salary, and then there's also dividends, just like on something that you would buy on the stock market. Now, if you pay yourself salary, there's always a reasonable compensation issue, and the IRS regularly audits that. Although I now have a brand new resource, and Chris, we haven't even talked about this, it's so new, but there are now there's a resource that I have that I can actually create a specific study as to what your salary should be based on years of experience, roles that you do, geographic area. I'm actually really excited about it. It's the coolest thing I think I've seen in the tax world in quite some time. So anyways, reasonable compensation issues, but now I think I can work pretty well around that. And then appreciating assets are a problem on dissolution, mainly because when you dissolve the C corporation, on a corporate dissolution, basically the assets are deemed to have been sold, right? You can't just distribute them out to yourself as the owner. And so if you're not planning on selling the asset, you're going to trigger a tax impact, and you're going to have to come up with money from some other source to pay the tax bill associated with that appreciating asset. So basically, once again, C corporation, not for rental properties, right? If your property is going to appreciate, you just really don't want it in that C corporation. So with that, let's talk a little bit about S corporations. Again, going back to the advantages, it's still a corporation, so the personal liability protection is unparalleled, right? Again, hundreds of years going back to English common law, saying that those corporations are going to be protected. There's limited risk of loss associated with that because of that liability protection. An S corporation is what they call a flow-through entity, which means that there's no double taxation, right? So we get rid of the double tax problem of the C corporation. The S corporation can limit self-employment tax, and then there's losses, basically because it's a flow-through, just like you were saying, Chris, because it's a flow-through business entity, any losses that are generated within the S corporation actually flow through to your 1040, so they can offset other taxable income you may have. For instance, if you also trade on the stock market, have a really great year, you can offset some of those losses using losses from the S corp. Or if your spouse works, right, and has a W-2, then you can offset some of that income. So S corporations are really useful for dealers, flippers, brokers, wholesalers, right? Again, anything really from afar, anything where we're generating that active income, right? We're not talking passive income once again. So let's talk about disadvantages of S corporations. It's not on this slide, but it's one that Chris and I have talked a lot about on other webinars, so I won't hammer too much into it. But there are kind of some headaches associated with S corporations. Mainly, you have to have payroll set up. There's quarterly filings with the IRS, Form 941, and annual 940. And then there's also quarterly filings with the Colorado Department of Labor and Employment. So there is some headache and cost associated just with running the S corporation, right? But then beyond that, there are actually restrictions on who can be an owner in an S corporation or a shareholder in an S corporation. Mainly, there's a restriction on the number. You can't be in the hundreds, but for, kind of a small family, it's fine and it should work just fine. There are restrictions on who can be a shareholder. So trusts, for instance, have to be drafted very carefully. Foreign individuals, they have to have, I believe, their green card. They have to be like an LPR in order to be a shareholder. And then you can't have like an S corporation own an S corporation, right? You have to be careful about who your shareholders are. There are restrictions on that. Finally, if you're more than 2% owner and you're trying to do some kind of fringe benefit like a health insurance or a retirement plan or something like that, you as the shareholder are actually going to pay tax on those fringe benefits. So sometimes C corporations are going to be a better fit for fringe benefits, and we'll talk a little bit more about that. So that's kind of the ideas behind corporations from afar, advantages and disadvantages. So let's kind of go back to this question, LLC or corporation, which is better? Well, what about limited liability companies? What about the LLCs? Well, again, they get personal liability protection. Now, the case law only goes back maybe about 30 years, but 30 years of strong case law saying that they're going to be protected. There's limited risk of investment loss because of that liability protection. They're, by and large, you can choose how they're going to be taxed, so losses potentially can offset other income, just like that S corporation. A lot of people tend to think of an LLC as kind of a hybrid between corporation and partnership, and so that means that there's less formality, kind of what I was talking about with the board of directors, shareholders, officers. You don't have to worry so much about that. It can be a little more lax like a partnership, but it's also protected more like a corporation. There's flexible membership. So the concerns about who can be an owner in the company, for instance, trusts, other business entities, foreign individuals, goes away, right? LLCs, pretty much anybody can be an owner. Very easy to operate because there is less formality, and they can elect their taxation. And that goes back to a concept we've been talking about a lot over the past couple of webinars. And that's basically that LLCs really don't have like a category under the tax code, right? An LLC instead can elect to be a sole proprietor disregarded entity. So it's on Schedule C or E. It can be a partnership, so it files Form 1065. It can be an S corporation, so it files 1120S, or it can be a C corporation, so it files 1120, right? So with that, it's kind of going back to the ultimate question here, LLC or corporation, well, which one's better? From a tax standpoint, it's actually kind of a non sequitur question because an LLC can be a corporation, right? And so really, which is better? The question is, well, do you want to be a corporation or do you want to be a partnership, or do you want to be a corporation or do you want to be a sole proprietor? The question actually doesn't really apply to the tax scenario. For the asset protection scenario, though, and we'll explore this a little bit more, corporations actually might be a little bit stronger, right? But the question is whether it's actually going to make sense to go through the extra headache and hassle of running that corporation to get maybe this like speculative better asset protection out of it. Yeah. So I think this is always a really good question. And like I said, I get asked it all the time, but it's such a loaded thing because the tax implications, the asset protection implications, and kind of just running through what makes the most sense. It really depends. And I'm going to show you kind of all of the things that will go into making that decision. And hopefully by the end of the webinar, you can actually answer which one you think is better. So great. Any questions so far, Chris? Are we doing good?
No, I mean, that makes a lot of sense. There is one question just popped up. It says, if a property is held by an individual, then transferred into a single membership LLC with the individual as a sole proprietor, does the transfer invalidate the title insurance policy issued to the individual?
Yeah, that's
a really good question and one I thought of before.
Yeah, so basically oh boy, I'm going to answer this, but it's going to change the question slightly. So basically, I don't think that the severance of title insurance is dependent on going from the individual to the LLC. I think what I'm more concerned about is the type of deed that you use. So there's the conventional wisdom and kind of what I hear kind of quote unquote on the street, the streets where they're talking about all these transfers of real estate. But at any rate, what I hear kind of out there is that you're going to use a quit claim deed and you're going to move it from you into the LLC, right? We know for sure, at least I know for sure, that the quit claim deed will sever title insurance when you make that transfer. So I always use a warranty deed, and I always advise my clients to use a warranty deed because basically you're making warranties about time, title, and there's 4 warranties you make in a warranty deed, and offhand I can't even tell you what they are. But because those warranties are present in that warranty deed, the argument is that title insurance would remain intact because you're still basically you're still making the same warranties that you as the original grantee received. So you should talk to a title insurance company or the title insurance company that you use or currently insures your current property. But I don't believe the concern is that it's going from the individual to the LLC. I think the bigger concern is what the transfer was. Was it quit claim or warranty deed? So hopefully that helps with that question. That's a really good one.
Yeah, and as I was reading the question halfway through, I thought it was going to be regarding, the type of loan used, because that's the most common question we get. That's the first time I've had that question. But a couple months ago, myself, Peter, and Joe Massey did a really good episode on should you put a rental property into an LLC, and it goes through like 3 very common scenarios. So make sure you check that out on the website, just denverinvestmentrealestate.com/LLC, and I'll take you there. But this is a really good question.
It's a great question. Yeah. And I'm
glad
glad
about that before.
I'm glad you the lending question by far, I get it asked every single day.
That's one
I
of the
think.
most popular questions I get.
Absolutely.
That's why we recorded episodes.
But this actually does come up. It comes up maybe once every month and a half or so. It seems like I see that question. I guess I've just never heard of a scenario where the transfer from the single person to the LLC, that's the issue. It's normally the type. But that's a great question. Man, I'm glad I came out here and did this. It's always awesome to see what comes up. So liability veils. Let's talk a little bit about this, best practices. Now, this is going to build a little bit on what I was talking about in 201, but I'm going to review a little bit about what I talked about in 201 just to kind of make sure everybody, in case you didn't see that or hear that discussion, at least we're kind of on the same page. So basically, when we're talking about liability veils, what we're saying is that when you create a company, like an LLC or a corporation, I keep saying that it gets great asset protection. Well, what does that mean? What it means is that the company itself kind of has this barrier between you as the owner and then the assets that are in the company. And so kind of visually, I'm representing this by having a company with kind of this this barrier in between the owners here. Back with the owners, we have personal residence, retirement account, car, whatever it is that they may own. And then down in the LLC, we have a property. Well, if something were to happen, if a tenant slips and falls, the argument of the tenant is that they're going to try to pierce through the LLC liability veil and get back to the personal residence, retirement account, car, whatever it is that the owner owns, right? And so here, there's an argument to be made about asset protection because last time when we talked about the liability veils, we talked about what we call reverse veil piercing, which would be like the owner of the company doing something wrong. So rather than a tenant slipping and falling at the property, let's say that an owner declares bankruptcy. Right. Well, there's actually a bankruptcy case here in Denver that the bankruptcy court pierced through an LLC and forced the LLC to sell real property that it owned. Right, which is really troubling for us as asset protection attorneys and should be troubling for real estate investors. Right. So there is an argument to be made actually that using a corporation would remove you from the consideration of the bankruptcy court because the bankruptcy court was looking just at a single member LLC, right? And so if you were to declare bankruptcy and we're kind of going in this reverse veil piercing direction and trying to see if we're going to get to assets of the company, using a corporation might be stronger because the thought process of the judge when the judge was determining whether he was going to pierce through that LLC may or may not apply. We're thinking that it probably doesn't apply because corporations are different than LLCs. Right. So there's the potential that this is stronger, but there are a lot of tax implications associated with having a corporation. So again, I wouldn't necessarily run out there and start putting rental properties in corporations solely because of this. Right. So is using a corporation worth it? Kind of based on that? Well, losing the flexibility on taxation really doesn't make it make sense, right? An LLC can be, again, a disregarded entity, a partnership, an S corporation, or a C corporation. If you're a corporation, you can only be an S corporation or a C corporation. You don't have the flexibility to be a partnership or a sole proprietor, disregarded entity. And giving up that flexibility probably isn't worth it just for this kind of speculative extra protection that you might get in that bankruptcy context, right? And then the other thing, going back to the idea of there being officers, board of directors, shareholders, right, is using a corporation worth it? Well, getting that extra formality and kind of the extra rigidness of the corporation may not be worth it either, right? Because then you're going to have 3 meetings, one meeting of the officers, board of directors, and shareholders versus just one annual meeting for the members of the LLC, right? Does that make sense?
Yeah, that makes sense. This is good.
Yeah. So liability veils, best practices. We talked a little bit about this last time. The biggest thing is just don't commingle your bank accounts, right? Make sure that you keep them completely separate. Your corporate accounts are going to be your corporate accounts. Business income is going to go in there. Business expenses paid out. Don't go to Safeway and buy your groceries using your corporate account. Make sure that you have those meetings. I talked about those kind of already, and keep your minutes. Actually type them out. Type out what you talked about, what you considered. Again, going into the judge and saying, here's 10 years of meeting minutes looks really good. That's going to help you get the protection out of the company that you're looking for. And at the end of the day, it's just running the business in a business-like manner, right? Don't be haphazard about it or lazy about it. Because if there's no formality to the company and your argument basically is, look, judge, I paid $50 to the Secretary of State. I organized my company, my LLC, or I incorporated my corporation, but I didn't do anything else. I should be protected. That argument's just not going to get you very far, right? We have to be really formal about how we do this. So let's talk more specifically about C corporations and a little bit about why you would select one or how we might use it. Here we do have to be careful because of that double taxation bit, and I'm going to talk a little bit about that. This is going to overlap a little bit with the tax discussions that we had before, but I think we need to go over it just to make sure that everybody kind of understands what I'm talking about when I say double taxation. But we'll talk a little bit about fringe benefits, and fringe benefits are really going to be where that C corporation shines and why we might consider setting up one. So looks like I had some transitions in there, but all right. So Double taxation. I'm going to talk about what a C corporation isn't really quick because I just want to be able to compare it. So this right here is what an S corporation looks like from a tax perspective. You have income flowing into the S corporation, and then the S corporation is going to file its own tax return. It's a Form 1120S. There's no tax due at the S corporation level. Then the S corporation does is it pushes out the income to the shareholders. It's a flow-through business entity. And then the shareholders pick up all of the tax back at their own 1040 level. So I have a star on this slide kind of back at the 1040, and that's to show that that's where the tax is paid. Tax is only paid once on this little infographic thing here, just showing you that, this is a flow-through business entity. There's no double taxation. Now with a C corporation, the situation's much different. So here you have income going into the C corporation. The C corporation is going to file a tax return. It's a Form 1120. And then I have a star there to show that the C corporation is actually going to pay tax at that level, right? Then it's going to pass out the income to the shareholders, either as salary or as dividends. And then the shareholder has to pick up the salary and the dividends back on their 1040 and pay tax at that level. So just 2 stars on there showing that once again, there's tax due at the 1120 level, the C corporation level, and then tax due again back at the shareholder level, the 1040 level, right? So that's that double taxation problem, right? The fact that the C corporation is going to pay tax twice. So let's talk a little bit about what fringe benefits look like, right? Or how we might use this. Well, if we go back to the idea maybe of like a rental structure, or even if we talk about shifting income maybe from like brokerage activity or something like that, what we can do is we can take income and pay it to the C corporation for some type of service that the C corporation is going to provide, right? Maybe the C corporation provides, like, it might act as like a property manager for rentals, right? Or for a broker, it might act as like an advertising company, or provide some type of other consulting services or something. So what you're going to do is you're going to divert income from your existing structure into the C corporation. And then basically that C corporation is just going to pay that income back out in the form of fringe benefits. So here in my example, what I'm saying is maybe you take 25 grand and divert that into a C corporation. And then the C corporation covers some fringe benefits for you to the tune of 25 grand. And so ultimately we have $0 left over, right?
Yeah, I think I follow this. Let me repeat it
to
make sure I understand. And I think I think a lot of listeners are probably in my same boat as me. So you're saying whatever other type of entities I have. So I'll just use my case, since I know there's other people out there like, so I'm a real estate broker, and I'll probably set up, I'll also have an LLC that is elects to be taxed as an S corporation.
Yeah,
those tax benefits.
Yep.
But then I will, from my S corp, I will pay my C corporation $25,000 a year in marketing activities, let's say, or something, to just kind of divert the funds. And then I'm running those expenses through the C corp, but the C corp is really just paying me out to cover all my health insurance benefits that can write those off.
Yep, pretty much. Yeah, exactly. And for you, Chris, exactly, like coming up with some purpose for that C corporation, like marketing for you, doing what we're doing here, right, would be a wonderful idea. But
you'd have to actually, I guess, if I want to get $25,000 in benefits, I actually need to pay more than that to actually have the C corp actually pay like a real service. So if let's just say I'm spending $25,000 a year in advertising budget, I pay myself $50,000, and then that $50,000 would cover, $25,000 in hard marketing costs and $25,000 in benefits, or can you just do a straight income shift and pay all fringe benefits?
Yeah, no, I wouldn't do a straight income shift. I guess when you say straight income shift, do you mean like 100% of your income?
No, I'm just saying if I pay for my S corp 25 grand to my C corp, does my C corp actually have to have like expenses for what I'm paying for myself, or can the only line item be my $25,000 a year in health insurance premiums?
Yeah, no, I mean, I would have some type of like business purpose for the company other than just providing the fringe benefits, right? Because and so what I would do is seriously look at your structure and figure out maybe what you could spin off in that C corporation, right? And so I think Chris, you did it so automatically that it shows almost like what a good fit it would be. We'd have to actually crunch the numbers, but either way, like if you have like a specific kind of like role in that you do that can be spun off into a different company, great. So for you, Chris, that would be marketing, right? Because that in a way is kind of independent of your brokerage activity. Like you could hire a marketer to go do that for you, even an independent contractor or whatever, right? In my own case, right, like I'm an attorney. I go to tax court, I go and represent people on audit, I set up LLCs, whatever. But then at the same time, I'm here for the sixth time, doing marketing of my own, right? And education kind of really ideally, but it's a form of marketing, really, right? And so in a way, like I could almost spin that off into my own company that's just me doing this activity, right? And so you're right, it may be 50 grand total, right? But let's say you have those $25,000 expenses in marketing anyways, you're just shifting it over to the C corporation rather than taking it in the other structure, right?
Oh, that's so cool.
Yeah, it is actually pretty cool, right? And so if we actually back out all of the income or darn near all of the income, well, the double taxation problem really kind of goes away, right? Let's look at that
because we're not showing a profit.
Exactly, because the C corporation essentially is just zeroed out, right? So great, we file the Form 1120 and maybe we just have a few $100 tax liability or we have a zero tax liability and it pushes things out to your 1040. But again, it's going to be basically zero, right? Maybe some dividends, maybe a little bit of a salary or something, depending on how well we can zero it out. But ultimately, what I'm looking to do, kind of big picture, is only shift over enough income into the C corporation to cover whatever fringe benefits we may be looking to do.
So another follow-up question on here. I mean, I get the game of trying to, zero out tax liability at the C corp level.
Yeah.
Do you ever run into, I forget the exact rule, but if the IRS has like there is it a business or is it a hobby rule?
Yeah.
Since a lot of people do that just for tax benefits, does that skirt, probably first you can explain what I'm trying to say there, but does that skirt that potential there?
Yeah. Yeah. So this is a deep question, actually.
All right.
Yeah. So basically for people to catch up, the IRS has, it's 26 USC 183 is the code section. And the fact that I know that shows that this actually is an audit trigger. And, it's something that seems like I dealt with maybe 4 or 5 years ago very often. And then it kind of died off. But for anybody who's involved in an MLM, like a multi-level marketing, Herbalife or I guess Avon's one, right? Like those kind of activities. The IRS regularly challenges those and, other people who are kind of involved in these, what they call red flag activities like horse racing, piloting, boat racing, things that you could do it and you can make money and it could be a business, but most people who might be doing it are actually doing it more as like a hobby, right? And I'm not saying your MLM is a hobby because I know how hard people work at those, but all the same, we on our side, and we being taxpayers and then the people who represent the taxpayers, we call it the hobby loss rules. The IRS being a little more strategic in how they present things, say activities not engaged in for profit, right? But either way, long way to say, if you don't have a profit intent, then the IRS can basically cut through and say, well, this isn't a business, right? And so then any income that you have, you'd have to pick up as income, but you essentially don't get your deductions or your expenses taken away from it or to zero it out. I have never once seen the IRS challenge this particular structure where we zero out C corporation earnings as a hobby. Would it be possible? I suppose, but I think what we would do is point back to the activity as a whole. including the company that's paying the C corporation the income. And I think when we look at it as a whole and we step through the 9 different factors that the IRS has around these 183 concerns, we'd still prevail. So I'm not overly worried about it. But Chris, that's a really, really good, deep question.
Okay, so in a nutshell, just kind of recap at the higher level before I kind of went down that tangent. So setting up a C corporation to funnel off for one of your line item expenses to pay for those expenses, which basically just shifts from the left pocket to the right pocket, but then putting extra out there to cover a fringe benefit that a C corporation can write off, but an S corporation or LLC cannot, such as like health insurance, is what is very doable and a very common practice.
Yes. Yeah, okay. It is. Now, I wouldn't advise everybody to rush out and do this today because really you have to sit down and plan and take a look at whether it really makes sense. And C corporations, they are rigid. They're old fashioned in a way. And so we have to do, once again, kind of a cost benefit analysis and say, does this really make sense to do? But, the other thing I would say, Chris, going back to the idea of that hobby loss, the 183 thing I was talking about, there is a safe harbor now that I'm thinking about it. And basically, if your company shows a profit for 3 out of the past 5 years, the IRS won't challenge it as a hobby. And so maybe you show, if you're really worried about that, maybe you show a minimal gain.
So like just a couple grand or something, where you're paying a few dollars in taxes.
Exactly. Okay, pay a little bit in tax for like 3 out of the 5 years just to get yourself in that safe harbor. Yeah, that would be a really good idea. Yeah, I'm glad I remembered that. But anyways, this is potentially a really powerful planning tip. Yeah. Okay. So, when we're talking about fringe benefits, what might we consider? I mean, providing health insurance is a great one. The other one would be a medical expense reimbursement plan. They call these MERPs. Plan, what we're looking at doing is reimbursing medical expenses that you, your spouse, or your dependents incur during the year. The advantage is that you're not subject to the 10% floor like you would be on Schedule A. So your itemized deductions, typically you can itemize medical expenses, but there's a 10% floor that oftentimes kind of phases a lot of us out to actually benefiting from that. And so the medical expense reimbursement plan is a way around that. So if you're a very high income earner, the MERP is a really great idea. On the other hand, if you have a lot of medical expenses, but you're somehow getting kind of phased out by this 10% floor, we're going to look at this medical expense reimbursement plan, right? It avoids self-employment tax, which, okay, we're good there. And then finally, you can use it with individual insurance, or you can supplement your employer coverage. And so eligible expenses with these expense reimbursement plans is major medical. You can do your co-pays, you can do deductibles, you can do dental, vision, chiropractic, you can do braces, LASIK, fertility, special schools, and over-the-counter medications, right? It's pretty broad. Now, that said, you can't kind of differentiate between owners and employees with a MERP. And so if you have a lot of employees, we're probably not going to implement this because you're going to be basically reimbursing every employee for all of their major medical co-pays, deductibles, right? You have people running out and getting LASIK and braces. Your staff is going to look really great, right? But at the same time, maybe we want to keep it to smaller companies where it's really just family, right?
Yeah, I think most of the people on there, they're all, one man or one woman shows, typically speaking, plus the spouse, plus the kids.
Right. Great fit for that. Yeah. So, that's more or less what I wanted to talk about was that MERP, but, you can also look at retirement plans. There are profit sharing plans. There are pensions, other things that we can look at that C corporation potentially can provide as well. And so, like I'm saying, basically you would just funnel enough income into that C corporation to cover your anticipated costs. With retirement plans, it's pretty easy. We know what the contribution limits are and those kind of things. We can plan for that. And then the medical expenses, we just kind of have a best guess as to what those would look like and funnel enough income to cover those, back them out by paying them out. And then again, just kind of backing out that as much of the tax liability as we can to avoid that double layer of taxation.
So from a very high level, is there like a general income level or amount of money where it makes it, basically makes the juice worth the squeeze for?
Yeah, I don't really have one offhand. It's
Okay.
actually something that I dig into pretty deeply. Frankly, it's not something I set up an awful lot of, mainly because I think most people just kind of look at it and say, that's getting too complicated.
Yeah.
I have that other slide in 201 where I talk about keeping things like kind of more simple versus complicated. This is definitely getting on the side of complicated because we're adding another entity into the mix. And then with like, for instance, the MERP, you actually have to have a plan document, right? That says that these are the types of expenses that are going to be covered and this is how you do it. Now, those don't have to be very difficult. I have a very form one that I tend to use when I implement this, but all the same, yeah, we're getting a little more, I guess like complicated, more difficult to run this structure. And so unless you have a lot of medical expenses, or you're looking at maybe like, my law partner is the greatest, Stephanie. A lot of you have worked with her, or a lot of real estate investors have worked with her. She's great, but she at the same time basically doesn't rely on health insurance really at all. She goes and sees a lot of alternative medical practitioners, right? And does a lot of, say, chiropractic and a lot of what's it called? Like homeopathy. Kind of homeopathic treatments and whatever else. And, that's kind of her personal choice, but that oftentimes falls outside of what traditional insurance is going to cover.
Yeah, you're out of pocket for that.
Exactly. And so in that case, like a MERP would be a really great strategy for individuals like that who are kind of seeking a more alternative lifestyle, right? Maybe a more, in their view, like healthier lifestyle, whatever, away from major medical and that kind of stuff. And, that would be a way to kind of fund that and get a break in pursuing that. So it kind of depends on who you're dealing with, right? And what their ultimate goals are. So good question there. So I'm not going to hammer this too deeply into the ground because I've been over this like maybe 5 out of the last 6 webinars, but the S corporations are great because they help you plan around self-employment tax, right? And so here income comes into the S corporation and you pay yourself one of 2 ways. You pay yourself reasonable salary and you pay yourself a shareholder distribution. Self-employment tax, which is roughly 15.3%, is due on the reasonable salary portion, but the shareholder distribution escapes self-employment tax. You don't have to worry about it. So just how that plays out, again, I'm not going to get too deep into this, but you can see the breakdown here. And with an S corporation, just doing a 50-50 split between distribution and wages, that will save roughly $7,650 on $100,000 of net income, right? So S corporations potentially can save you a lot, but there is headache and hassle that goes into that with the wages and working with a payroll company and the filings and all of that. So we do have to decide if that's worth it. So let's talk about something new today, though. The 199A deduction.
All right, good.
Yeah.
This has confused me since the tax bill a couple of years ago.
And the reason is because it looks something like that.
Yeah.
Yeah.
So he's got a very bloated flowchart on here.
Yes, this flowchart comes to me courtesy of the AICPA, the American Institute of CPAs. And it's funny because it says it's your 20% business tax cut in a nutshell, but then it's this really complicated flow chart with a lot of numbers on it and a lot of kind of, and this is only the front page, actually. There are examples and things on the back that make it even worse.
So you got like a 5-foot poster hung up in your office with this?
There was a period of time right after the Tax Cuts and Jobs Act came out, that I literally had maybe like a 35-page just like cheat notebook on my desk because so many people were asking about it and so many people were wondering what their deduction was that in a way it's like a large part of my year was actually just sitting down and like projecting what their new deduction was going to look like. But I had to step through all of this. So thank God those days are past. But at the same time, it's complicated. So I'm not going to talk about really like everything related to 199A because that's probably a webinar unto itself. But what I am going to talk about is maybe the most salient point here for the S corporations. So basically with 199A, we have a new type of income, right? And so going back to even the earlier part of this webinar, I was talking about like active income and passive income, right? Well, ordinary income would be like that active income. Investment and passive would would be like the passive income. But either way, really under the tax code, you have 4 different types of income: ordinary, investment, passive, and then now this new type, which is called qualified business income. And qualified business income is what we care about when it comes to 199A. That's the amount that the 20% is going to apply to. So the starting point is that the qualified business income has to come from a pass-through business entity or a flow-through business entity. We're talking a partnership, S corp, sole proprietor, disregarded entity. C corporations are out. A C corporation is not going to give you qualified business income. Qualified business income specifically is net income from Schedule C. So if you're a sole proprietor and you're out there doing your thing, the net income that you're going to generate on Schedule C counts as that qualified business income. We're talking trade and business income from partnerships. We're not talking guaranteed payments or investment income. It has to be, trade or business income, not the kind of passive income coming from the partnership. Again, trade or business income, again, from S corporations, but with an S corporations, it's not going to be the W-2 wages, the salary that you pay yourself. And again, it's not going to be investment income that the S corporation may have. It's got to be trade or business income from the S corp. Real estate investment trust, REIT, dividends from that will count. Publicly traded partnership income is going to count. Qualified agricultural co-op income, if anybody has that, that's going to count. And then what I don't have on here, but we do know, is that rental income is going to count as qualified business income. So qualified business income has a very specific definition to it, and it's really this new type of income that's carved out in the tax code. So basically, you're going to total up the total amount of your qualified business income, and then there's 3 significant limits that potentially apply to the 199A deduction. One is specified service business, which I'm going to talk about that today. But there's also W-2 limits and a 20% limitation. So you have to work with your CPA or tax preparer to kind of figure out the rest of the limitations. But let's talk about specified service business, because really that's going to go more towards the kind of active income earners that I was kind of trying to target today with the content. So a specified service business, the best way to do this is just to read the definition of what this is, and this comes directly out of the code. But it's any trade or business involving the performance of services in the fields of health, law, accounting, consulting, financial services, brokerage services, or any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees. So in that definition, you can see laws in there. So I'm a specified service business, and then brokerage services are in there, right? And so real estate brokers, this is going to apply to you. And then any other trade or business where the principal asset is the reputation or skill of the employee, that's also going to apply. So even if you kind of are, you escape like health, law, accounting, consulting, right? You're not in any of those types of businesses, you still can get clawed back in if your trade or business relies too much on your reputation or skill, right? So this is pretty broad. It's going to apply to a lot of people.
I still don't understand how agents escape that. I'm guessing it's the National Association of Realtors lobbying or something.
Well, I don't think you do escape it, because there's brokerage services, right? And so you might fall under brokerage services. The vision of Congress may have been that would only be for the stock market, right? Or like financial planners or whatever it may be. But either way, even if brokers do not fall under brokerage services, I think you're still going to get clawed back, because reputation and skill, right? Like, aren't you guys all like referrals and your reputation around town? Like,
yeah, I mean, again, from my 30 minutes of Googling research months ago, I thought realtors had gotten carved out of this and that they could qualify for the QBI, which doesn't make sense to me, because realtors,
Oh, yeah. So that's a wrinkle here, because, okay, let's say you fall into a specified service business. Well, you're not out of luck, right? All it means is that some phase outs are going to apply to you.
Okay, so it's not like a black and white end of the world.
Yeah, yeah. Like, just because I'm a lawyer and I fall into the field of law doesn't mean that I don't get 199A. It just means that these phase outs apply to me. So basically, with single filers, your phase out begins at $160,700, and then it ends at $210,700. So if you're a single filer and you make $210,700 and you're in the specified service business, you're not going to get any 199A benefits, right? You're completely phased out at that point. If you make 160,700, well, you're going to begin to get less 199A benefit, and it's going to kind of titrate up to no benefit at 210, right? For joint filers, it's $321,400. That's going to be where the phase out begins, and then the phase out ends at $421,400, right? So basically, yeah, you still, even if you fall into that definition, you're going to get some 199A benefit, but you have to be one of these really top earners to have no benefit, right?
Okay.
Does that make sense?
Kind of.
Yeah. Yeah. Yeah, that's, I mean, we can go over more of that if we need to. That's perfectly fine. But yeah, so I mean, closing thoughts here, what's better, an LLC or a C corporation? Let's start with that. I mean, from a tax perspective, it's going to be identical, right? Because an LLC can be a C corporation or it can be an S corporation. From asset protection, potentially it could make a difference, but there's going to be a lot more formality associated with that corporation, a lot more time, energy, headache just associated with running it. That to me, there may have to be some real specific reason why you would want a corporation over an LLC tax, say as an S corporation or a C corporation. I think the flexibility of the LLC paired with the tax picture of a C corporation or an S corporation, that's probably going to be the way that you're going to want to go, right? But either way, you really do need the full picture if you're going to do this and kind of figure out exactly what the best thing is. And if you're not looking at the taxation, and I would argue really the strategies around the taxation, like the MERP, for instance, that's just one idea out of a lot of ideas that you can potentially do. You're not even really doing the bare minimum, right? The bare minimum for me, a lot of people, and this happens to me a lot at trade shows. Once again, my mind clearly is on trade shows. But people come up and they say, well, I paid my $50 to the Secretary of State, so I'm good. It's like, well, good luck. That's not going to stand up. It's not going to be exactly what you need, right? So if you're not looking at taxation and strategies, I would say you're not even doing the bare minimum. You're pretty much just like paying $50 to the Secretary of State and hoping that you're going to be good. So with that, a quick plug. Come see me for tax coaching, right? What we do with tax coaching is we go through your tax return with a fine-tooth comb. We actually come up with really targeted strategies that make sense. We can actually project down to the dollar figure and say, look, if you implement this particular change, you're going to save X amount of dollars. And we actually help. It's an ongoing coaching relationship. We actually don't just give you the recommendation. We then help you actually implement the recommendation, because otherwise we'll just have the same conversations year after year after year, right? So I would highly recommend that you come for tax coaching. Then we can see what the business entity looks like and what the best strategy is going to be over there, and we compare that whole picture together. So that's my hard sell of the day. You're not alone. You can add us to your team, and with that, I'm happy to open it up to any more questions that we may have.
Yeah, I'm just going to kind of go back to the QBI question, just because this is still hazy, and I was hoping that you would have an example here towards the end, but I didn't see one. Can you kind of give me like just a high level, because this might be opening a can of worms, but like, I mean, so if I just have $100,000 in QBI and I take out 20%, I'll get a 20% write-off from there. Is that the very high level understanding of it?
Yes.
So Peter's saying yes, and he's pulling something up on his computer right now to show me.
Well, I'm going to do a combination. Number one, in case I need to write, I can write. But number two, I'm going to go back to that awful flow chart, because that actually to me is the most helpful. So first off, you have to have a flow through business entity, right?
So everything, but not a C corp.
Right. And even if you just are a sole proprietor, Schedule C, right? It's okay if you're not even a company, but basically that's the starting point, right? So then you have to ask, well, do you have that QBI, right? Because there's these 4 types of income, and so do you have qualified business income? So qualified business income is not going to be W-2 wages or investment income, right? It's going to be trade or business income is basically what we're talking about. So if you are like a partner in a partnership, or you're a shareholder in an S corporation, it's the amount that's going to come out on your K1.
Okay.
Right? It's not going to be W-2 wages or anything like that. It's going to be the K1 amount. So let's say that you have $100,000 of K1 income. And let's stick with the example where you're a real estate broker.
Yes.
Right? All right. So then 3 significant limits. Specified service business. Do you fall under the specified service business? I argue that you do, because you're either going to be in the brokerage services category, or the reputation and skill of you is going to claw you back into that specified service business. So then do we have a phase out we have to worry about? I mean, if we're talking $100,000 of qualified business income, no, we don't have to worry about it. Whether you're a single filer or a joint filer, you actually fall under the phase outs. So you're looking at $20,000, right? 20% of that $100,000, right? There are these W-2 limitations and the 20% limitation.
So before you go on to that, let me ask you, so going back to the agent, so I get having a K1.
Mm-hmm.
So I guess since I'm a real estate agent, I can only take that off my K1 amount. Is that where that's coming from?
Right.
Okay. That makes more sense. I'm following now.
Yeah,
okay.
Because we're really only talking about the qualified business income, which is going to be that K1 amount.
Okay.
Yeah.
Okay. The water is getting a little bit less muddy.
So in times past, when I've talked about 199A, like in person at like a speaking engagement or, whatever, oftentimes what I do is I approach it this way. I say, okay, so we have this new 199A deduction, right? Basically, we have qualified business income. Here's what it is. Now deduct 20% of that. It's that easy. Or is it? Right? And then I pretty much just leave it at that, right? Like put up that flow chart and say, it's not really that easy, right? But you're going to have to work with your CPA. Here I'm trying to do a slightly deeper dive, explain this a little bit more. But ultimately, it is so calculation driven and so complicated and still so new that really you could teach an entire webinar just on 199A.
Okay.
You really could.
Well, I'm looking forward to my taxes next year, kind of see how this plays out. So I'll learn a lot more then, I'm sure. So we did have a question here from Scott. He said, Peter, where are you located and how do we reach out to you?
Yeah.
That would probably be an important detail.
Yeah. The best thing I can recommend, one of 2 things. So I'm located in Cherry Creek, 55 Madison Street. That said, we offer phone calls, we offer Zoom meetings, we can be face-to-face via webcam, whatever works best. We're trying to really embrace a lot of technology as of late. We used to be a really old, stodgy law firm, and you used to have to come in and meet with me at the conference room table, but that's quickly changing. So at any rate, info@bigprofitsolutions.com. That works. You can also reach me at pmcfarland, PMCFARLAND, at longlg.com. That's for Long Law Group, the sister company there. Either one of those works, or my phone number is 720-922-1120.
So I think to keep it simple, if people went to www.bigprofitsolutions.com, all the contact details are on there, right?
Yeah, info@bigprofitsolutions will be there.
Or for the email, I'm saying if they went to Google and brought it up.
Yep.
Cool.
Yeah.
Awesome. Well, this was great, Peter. So I learned a lot. So yeah, just thank you. And can't remember if I said this at the beginning, but I've had, as we've done these series over the last, couple months now on taxes and business, and I've had a lot of great feedback from investors around town and listeners to the show. They've all been very thankful and appreciative of that information. So we all say thank you.
Yeah. Well, thank you for the opportunity. I also very much appreciate it.